Gold prices rose to a 9-month high yesterday. This is amid fears of a global recession and also hopes of slower rate hikes from the Federal Reserve. Meanwhile, central banks set a new record of gold purchases in 2022, according to the World Gold Council. The world's central banks bought about 400 metric tons of gold in the third quarter last year. Purchases of gold have reached a level not seen since 1967. But why are central banks buying so much gold? A Mises Institute article explains that it's to protect their balance sheets. We talked to the author of the article for an in-depth explanation. And now joining me now is Daniel LaCalle to talk about why central banks are buying gold. So, Daniel, I was just reading your article on the Mises Institute site. So you talked about one reason why this is happening is because of a possible digital currency. Maybe just on this point, expand a little bit.
A lot of the central banks globally are now loss-making because they have been buying bonds and even ETFs or mortgage-backed securities that are losing money right now. So many of them are loss-making, and they need to purchase gold to prop up the balance sheet, to improve their reserve base, but also because the threat of a digital currency means that a lot of investment banks that used to treasure US dollars or euros are scared because with the introduction of a digital currency, the risk of even decreasing the purchasing power of the currency even further than what it has happened in recent times is very high. So those central banks, particularly Asian, are looking at the risk of holding too many dollars and too many euros that could lose their purchasing power much more rapidly with the advent of a central bank digital currency. As such, they look to add more gold, which ultimately gives them a higher cushion and a better reserve of value.
And as well, you earlier you mentioned loss making. In your article, you said monetary devastation. Can you talk a little bit about that?
Well, think about this. Central banks have been purchasing extremely expensive bonds, sovereign bonds at negative yields, at negative real yields. They have been purchasing mortgage-backed securities at very elevated prices, and also in the case of Japan, for example, equity-traded funds. And in 2022, when the markets fell, all of those assets have lost massive amounts of value, and they're loss-making right now. So the balance sheet of the central bank is actually in need of a bailout. It needs to be recapitalized. And this is extremely dangerous in a moment in which if they purchase more bonds and mortgage-backed securities, they would increase the problem that they have already incurred into. And if they continue being loss-making, confidence in the purchasing power and the currency and the central bank itself may fall rapidly. So it's a very challenging situation for most of the developed countries' central banks.
So what I'm getting is basically essentially what it all comes down to is the stability in the value of gold. Would you say that's correct?
Yeah, absolutely. If you think about it, the gold is the only decorrelated asset and one that has proven to be a reserve of value for centuries. So for many decades, central banks have reduced the percentage of gold in their asset base and increased the percentage of equities, bonds in the so-called quantitative easing period. But with the collapse of markets, especially bonds and equities at the same time in 2022, what has happened is that the fragility of those assets and the fragility of the asset base of central banks has come to the fore. This is very evident right now. And as I said before, they're loss-making. So gold ultimately is proving to be the stability factor that many central banks require. On top of that, the fear of a central bank digital currency that I mentioned before is making a lot of central banks in Asia, in Latin America, etc., think twice about increasing their exposure to the US dollar or to the euro, because that means that with a badly implemented digital currency, the purchasing power, the value of those assets in euros or dollars could decline rapidly. No? So what we're basically looking at is monetary debasement globally. And that monetary debasement and the collapse of so many of the balance sheets of central banks are making the situation a lot more challenging.
So, I want to talk about this loss making, this monetary destruction. What do you think the solution is? Is it gold?
Well, the solution is certainly to have sound money policies. So to start with, to stop this insane constant money printing and purchasing very expensive assets, no? It's not the same, think about this, it is not the same when a central bank purchases a sovereign bond that is mispriced because there's a perception of too much risk and the bond has massive yield. Therefore, it purchases it and it frees up liquidity in the system, and that quantitative easing process generates a positive return. The central bank makes money, pays it back to the treasury, and it frees up the balance sheet of commercial banks. That is the way quantitative easing works. The problem is when quantitative easing, instead of being an emergency procedure in times of crisis, has been something that has been going on for almost 2 decades non-stop, even with very elevated, extremely high prices of bonds. Think about this. When the central bank in Europe, for example, the European Central Bank, is purchasing negative yielding bonds from sovereign issuers, what it's basically doing is not helping the economy. It is basically propping up a bubble that is very dangerous. And that bubble burst in 2022. That is why what we're living is a slow burn monetary debasement.
Okay. So, and another thing in your article, you mentioned a new paradigm in policy. I'm curious, what exactly is this paradigm shift?
Well, the new paradigm is that after almost 2 decades of constantly lowering rates and increasing liquidity, what we're seeing is quantitative tightening and rate hikes because of elevated inflation, isn't it? No? So what happens globally is that many central banks, particularly, as I said before, Asian central banks, are fearing that their exposure to the US dollar and the euro in particular is very high, and it's too high in order to maintain the stability of the balance sheet of the central bank. You think about this, what US Treasury bonds, US bonds, are assets for many central banks. No, so when those central banks are purchasing U.S. Treasuries, they are doing so because they believe that it's a stable asset that is going to rise in value and that is going to continue to have a certain value for a prolonged period of time. That all crumbled in 2022 with the arrival of inflation. So that's why it's a new paradigm, because on the one hand, central banks in developed economies cannot go back to quantitative easing because they're loss-making and because inflation is elevated. And on the other hand, the value of those bonds remains extremely fragile because they were extremely expensive to start with. So it's basically the equivalent of a bubble that is bursting.
Okay, so bringing it back to gold, and just one last thing, in light of central banks, buying gold, where do you see gold prices going?
Well, obviously, the first element that is positive for gold is the supply and demand scenario. Supply is extremely tight and demand is rising globally. Now, the second one is obviously its value as a reserve globally. Everybody understands, and we saw it in 2022, that the price of gold is very stable, even in periods of very aggressive moves in markets. The third one is obviously the fact that central banks are starting to buy more gold in order to keep their balance sheets relatively safe and relatively stable. So those three elements, higher the tightness of supply demand, plus the component of reserve of value in a period of recession or stagflation, which is the risk right now, added to the need from some central banks to diversify out of the euro in particular, but also the US dollar, is propping up gold demand. So I think that the likelihood of its price continuing to rise is quite significant also because it's an asset that is very underweight in investor portfolios. Investors tend to be extremely overweight equities or bonds or both, and have very little exposure to precious metals. So I think that that is another reason, is that the financial world needs to catch up to at least be equal weighted.
All right. Thank you for your insight today, Daniel LaCalle, Tress's hedge fund. Great having you on.
Thank you so much.